I tend to manage my portfolios relatively dynamically. So there are times to be more aggressive in portfolio construction, and there are times to be more defensive. In 2006 and 2007, when there was limited opportunity for total return in high yield, I positioned the portfolio more defensively. During the credit crisis, there were great opportunities with the market volatility, so I increased the aggressiveness of the portfolio construction. At the end of 2010, as spreads in high yield continued to narrow in and there was again limited opportunity for total return, I reduced the risk profile of the fund, both in terms of average credit rating, where I increased the average credit quality in the fund, and as importantly, from an industry perspective. So I wanted to be overweight those industries that weren't reliant upon rapid growth for those companies to do well and for the credits to improve. So by way of example, my two biggest overweight industries currently are in the telecommunications sector as well as in the healthcare sector. These are two industries where consumers will continue to spend money whether the economy is good or not so good in the United States. So these are considered defensive sectors, and they're my two biggest overweight industries, and I think that's the appropriate way to be positioned at this point in time. So again, my industry positioning is really built from our intensive bottom-up research that we do at Fidelity as part of the high income division. With close to 24 dedicated research analysts in high yield, we feel that we have a better view on the fundamental prospects of our companies than most of our competitors because we arguably have some of the best resources focused on this asset class. And based upon our bottom-up research and analysis, we're looking for the best risk-adjusted return opportunities we can find in the marketplace. So between the bottom-up research that our analysts are doing, as well as my top-down view of where I see the risks in both the economy and in the high-yield market specifically, that has driven the large overweights that I just discussed in terms of telecommunications and healthcare. Underweight positions are largely driven by, again, what I view as not very attractive risk-adjusted return opportunities. So, for example, the housing and building product sectors are two industries that I am currently very much underweight relative to the index. It has always been our thesis, or my thesis, that the housing market in the United States wouldn't quite recover as quickly as people had expected and didn't see great value in investing in home building bonds in the United States. Another example, for a different reason that I'm underweight, is actually the energy sector. So I don't currently view the risk to the downside to oil prices as being particularly significant, but it just so happens that many of the big issuers in the energy sector in U.S. high yield really don't present a very good risk-reward opportunity for investors. So there are some very company-specific instances where I do have a significant investment in those energy companies, but in the aggregate I'm currently underweight the energy sector.